What is happening, investors? It is your boy Jack back with another video. Yesterday, for the first time in nearly 2 months, I took a day off making videos, but it does feel very good to be back. Today, baby, we're going to be speaking about 5 very high paying dividend stocks. These companies pay between 5 to 9% dividend yield every single year. And not only that, they're companies who have been around for a very long time and have paid and increased this dividend for a very long time. So if you are a long-term dividend investor and you don't know what stocks you should be buying right now, with so many different companies cutting their dividends because of the times we've fallen on, these could be some good picks for you. I'm going to start things off by speaking about the highest paying one, and we'll work our way down the list. I've spent the last few weeks, buying big tech giants and buying some of these higher risk, higher return companies. So now my main focus is on just finding some really nice valued dividend companies, because that is what I want my portfolio to mainly consist of. I obviously love having the likes of Google and Microsoft and Apple, the companies who don't pay a dividend or pay a very small dividend, but I want most of my companies to pay that nice dividend, baby. And right before we get into the very first company today, please drop this video a like because it helps me out so much. Drop me a comment, let me know what dividend stocks you're looking at this week, and subscribe if you're new around here, baby. We are on the road to 4,000 and then 5,000 subscribers. It is crazy to even say that. Anyway, right, straight into the video, stock number 1. So guys, the very first company we're going to speak about today is Altria Group, okay? They're in consumer staples. They sell tobacco and other things that we will get to quite shortly, okay? They have a dividend safety of 55, a massive dividend yield of 9.15%, and an uninterrupted dividend streak of 50 plus years. So that makes them a dividend king. So be it. When times got tough before, that dividend had to be cut, but they did keep paying it, and then they continue to grow it as well. So there is quite a lot to know about these guys, but a few really important things. They have exclusive US rights to sell cigarettes, primarily under Marlboro, Parliament, Virginia Slims and Benson & Hedges brands. Now, I don't smoke, and I still know that these are some very, very big brands. They also market cigars, chewing tobacco and table wines, and they own a 10% stake in Bud. You know who they are. They sell Budweiser and loads of other things. So essentially, cigarettes, beer and wine is what these guys are in. They also have a 35% stake in Juul, which is the leading e-vapor brand, and we can just see just how popular vapes have gotten over the last few years. So they're in a few different places. And they also own 45% of a cannabis company called Cronos. So they're in a lot of different sectors, all to do with smoking and drinking essentially. But their cigarettes account for nearly 90% of total sales and 85% of operating income. So that is the biggest thing you're investing in when you invest in these guys, is cigarettes. The biggest risk we have to look at in regards to these guys, obviously most of their money comes from cigarettes, and a lot of people are trying to get off cigarettes, or they're moving to vapes. So that is obviously quite a worrying thing, but realistically there is always going to be an awful lot of people who do smoke. The main thing that worries me about these guys is their max stock chart, and we can see that it's been a pretty shaky last 3 or 4 years. It has been going down and down and down, which is never what you want to see. And this more than likely is largely down to the fact that less and less people are smoking on a yearly basis, and that is also more than likely why these guys are trying to get into people like Juul and people of the like, so that all of their money is not just dependent on these cigarette sales. They're going to have a few more revenues, and they can start putting more time and effort into these ones that will be sustainable. So like their wine, like their e-vapes, things along those lines. So for me right now, they're more of a stock to watch than a stock to buy. I'm not 100% and completely and utterly convinced that I want to get in them, just because of the nature of the business and the nature of, the decline in numbers of people smoking cigarettes. And the balance sheet is okay. It's not the best in the whole world. So we've 7.9 billion in current assets, 52.6 billion in total assets, 11.1 billion in current liabilities, and 55.9 billion in total liabilities. So not the best in the whole world, but not absolutely horrific either. So right now their payout ratio is about 75 to 79%, which may seem very high, but for tobacco companies it's not too bad. And despite the fact that less people are actually smoking, their total sales have climbed up very slowly but very consistently over the last few years. And their Q1 earnings did recently come out, and there was actually some very good outcomes, okay? So their net revenue was actually up 13% from this same quarter last year, and their adjusted diluted EPS is up 18.5%, guys. So quite a good Q1. But anyway, that was company number 1. Now, on to company number 2. Exxon Mobil Corp. So one that you more than likely all know, one I do own a position in, and one I plan on buying more in. So they're in oil and gas. Dividend safety of 55. Dividend yield, again, a massive one of 7.54%, and a dividend streak of 37 plus years. This line here is from a month ago, but they did come out and said they've reduced spending and they reaffirmed their commitment to the dividend. And I fully expect these guys to keep paying their dividend. I really do. I've spoken about these guys a good few times. You more than likely all know who they are, so we'll make it quick. Upstream accounts for 50% of their earnings, downstream 28%, and chemicals 22%. Quick look at the balance sheet, okay? Current assets, just over 50 billion, massive. Total assets, 355 billion. These are a massive, massive company. Current liabilities, 64.7 billion, and total liabilities, 167 billion. So definitely not a particularly bad balance sheet. Obviously, current assets v current liabilities isn't the best in the world, but they will manage it. They will get through that, no problem whatsoever. So Exxon's Q1 earnings recently came out as well, and they reported better than expected results for first quarter 2020. So obviously a good thing. Upstream, quarterly earnings of 536 million plunged from 2.9 billion a year ago, primarily due to lower oil and gas price realizations. The downside was offset partially by higher liquid production volumes. We all know what's going on in the world in regards to oil right now. It's what everybody is speaking about, and that's why these things are happening. Exxon in general has had a very shaky last few years, and it's clear to see that when we just look at the stock chart. I mean, they got down as low as $32 a share. On the 5-year chart, as of right now, we're down 47%, guys. It's terrible. And even on the 6-month chart, they're down 34.35%. So obviously, they've performed very, very poorly. And now it's going to be even harder because of everything that is happening with oil in the world. But from a long-term point of view, I still think that they have incredible prospects. Now, I could be completely wrong. Again, these companies that come with the very high dividends are obviously somewhat higher risk, but I personally do really like the look of Exxon. I'm happy to own them, and I do want to buy more. I do 100% understand it may well be a shaky road going forward. Really do understand that. But you know what? It's part of a highly diversified portfolio. I'm fine with it. It's important to understand that if you're going to get into any oil related stock, it's going to be cyclical, and there's going to be bigger highs and lower lows than, you know, some of the safer dividend stocks that are out there. But a lot of that is offset by this 7.54% dividend yield. A lot of people do consider these guys to be a relatively safe investment despite everything I just spoke about. And again, I'm just happy to own them. Okay, so that is it for Exxon. Number 3, AT&T, baby. Okay, so dividend safety of 65 and a dividend yield of pretty much 7%, okay? I am in these guys and I love being in them, and they also have that uninterrupted dividend streak of 36 plus years. So be it, the growth has been slow, but their dividend yield is at nearly 7%. Of course it is going to be slow. So AT&T's Q1 earnings did recently come out, but they have said that they expect to maintain healthy dividend coverage, which is fantastic. From a dividend investor's point of view, that's the kind of companies we want to invest in right now, the ones who are going to keep paying this dividend, you know? When we were speaking about airlines before, nearly every single airline has had to cut their dividend. If you were looking at them for the dividend, it's gone. Whereas a company like this, you expect that dividend to keep up despite the tough times we're in. So another very big balance sheet when we do have a look at AT&T. Current assets, 52.7 billion. Total assets, 545 billion. Absolutely massive. Current liabilities, nearly 70 billion, and total liabilities, nearly 350 billion. So you know what? Not the best in the whole wide world yet again, but they will be able to get through this, you know, situation. They'll be absolutely fine, and that's why I do believe that the dividend is very safe. And very similarly to Exxon, AT&T have had quite a shaky last 5 years, and again, you can see that if we look at the max stock chart. It's weird, man. There's been a lot of weird things going on. There has pretty much been some very slow and steady growth, and then these last few years were quite tough. What I think is a good thing to do whenever you want to invest in a company, though, is to look at the stock chart last, to look at the fundamentals first, the dividend, all of the money, things along those lines, and decide if you like the company before you ever set eyes on their stock chart. And when I do all of those things with AT&T, I absolutely love what I see. So does a bad stock chart necessarily turn me off? It genuinely does not. Obviously, I would rather see, you know, a way more promising stock chart, but that's the nature of it, especially usually when we see these really high dividend paying companies, the stock charts aren't quite as pretty. So what I really like about AT&T is they have set themselves up as the biggest telecommunications market in the US. So they have set themselves as the best of the best in the US, and to make matters even more challenging for potential new entrants, most of AT&T's markets are very mature. Approximately 96% of US adults own a cell phone, for example. So it's going to be very hard for a new, you know, company to come in. I'm the same, man. I live in Ireland, and I'm with a company that I know forever, and I like them. And if some new company showed up and said, you know what, I'll give you the exact same service for €5 less, I still wouldn't go with them just because I'm happy with the price I'm getting and I trust them. So it's going to be very hard for any new players to come into this space, and that's why I absolutely love AT&T from a long-term perspective. They're the biggest of the big boys. They've taken a number of bold steps in recent years to proactively take on changing industry conditions across wireless, video and media markets. And you know what, these things, we may not be seeing the fruits of their labour just yet, and that may be why it's been a relatively tough, you know, few years for these guys in regards to their stock price. It will probably take at least several years to determine just how savvy these massive capital allocation bets actually are. For now, AT&T remains a mature cash cow that is a reliable source of income over at least the short to medium term. With these guys, I do 100% there will be some absolutely amazing growth in the long term. I don't know when it's going to happen, but I do think there'll be a stage where something comes out from these guys and they just absolutely smash everything and the stock goes boom. And in the meantime, they have that very nice dividend. With all that being said, right, let's have a look. Number 4. Okay, so now we're looking at a company who I don't own just yet. Federal Realty Investment Trust. So they are a REIT. They're an REIT. Dividend safety of 60, dividend yield of close to 5.4%, and an uninterrupted dividend streak of 52 plus years. So again, you love to see this in times like this where you want to invest in a dividend company, but you don't want them to cut that dividend. So a 52 plus year dividend streak is quite a good sign that they're not going to cut it. Federal Realty vocalizes strong commitment to dividend despite disappointing April rent. And this only came out a few days ago on May the 8th when their Q1 earnings came out. So although the earnings may have been somewhat disappointing, they're still telling us, you know what, I want to keep paying you this dividend. We want to keep rewarding new investors. So they specialize in high quality neighborhood shopping centers that are anchored by grocery stores and located in large affluent markets such as Silicon Valley and New York. And a few important things for a REIT, okay? So they own 104 properties, comprising 24 million square feet of leasable area, which is under long-term lease to over 2,900 tenants in numerous subcategories. No single retail category exceeds 10% of their operating income, and no tenant is greater than 3%. So they're highly diversified. So just because one company starts doing particularly poorly, it won't affect them all that much. And REITs can be a scary place to invest right now because a lot of the world is moving online. I spoke about this in my last video when I just invested in Amazon. These guys, about 65% of the firm's rent is from tenants who operate in relatively e-commerce resistant industries like grocery stores, restaurants, fitness centers, health and drugstores, autos and entertainment. So what that says to me is that they understand just how much of the world is going online and how much you can buy online, and they want to rent out a lot of their properties to people who won't be affected near as much as these online retailers get bigger. And what's cool about these guys is they've raised their dividend for 51 consecutive years. The longest dividend growth record of any REIT, making its sector's only dividend king. So if you're a long-term dividend investor and you want to diversify your portfolio and you want to get into an REIT, this is a great place to start. Now they were obviously some of the pros, some of the cons. About 35% of the rent does come from tenants in potentially e-commerce sensitive industries such as apparel and electronics, and they also work with some struggling retailers such as the Gap, or these fellas, I don't even know who they are, or Splunk, I don't even know who they are. So if these guys are to potentially go under, if stores do have to shut down, it will temporarily affect these guys' income, of course. But from what I can tell, their focus is on, you know, getting in the companies who won't be as affected by e-commerce, and they will continue to do that going forwards. And you know what, the ratio may go from 65% to 35% up to 75 to 25, and eventually they'll just have a lot more of these businesses who aren't as susceptible to, you know, e-commerce taking their business. Total assets 7.75 billion, total liabilities 5 billion. So great balance sheet by these guys. And we're seeing a thing today, another company who has struggled the last 4 or 5 years. You know, there was some absolutely incredible growth coming out of the Great Recession. Then we have a look at the last 5 years and they've just been trading extremely sideways. And then we get to where we are right now and we've dropped 37.5%. These are a company I do plan on buying very, very soon. They're a dividend king. They've increased the dividend for over 51 years. They're at a relatively low price to where they have been as of late. REITs in general can be quite a cyclical industry, but I'm happy with the price they're at now, and I more than likely will buy some this week. Who knows though? Who knows? We'll see. They went into this whole mess in a strong position from both an operational and most certainly a balance sheet perspective, as I did just show you. So the real question is, will they make it through? And what will we look like on the other side? First things first, yes, we will make it through. They're going to make it through. That's what we want to see. And not only that, but they've every intention to complete all of their developmental projects that are partially constructed. So they're still looking to the future. They're still trying to expand. They're going to survive. I think it's a fantastic opportunity to buy these guys. And that 5.38% dividend is absolutely beautiful. Okay, with all that being said, on to the last company today, company number 5. We have another oil-related stock, Chevron Corp. And I spoke about these a few times before and how much I do love them and I do own them and I want to buy more. So dividend safety of 65 and a dividend yield of 5.4%. And an uninterrupted dividend streak of 33 plus years, which has actually grown quite nicely over the last 20 years. So great start. And again, they have come out and said their focus is on protecting the dividend, which that's what today's video is all about. Investing in companies that will keep paying this dividend despite how tough times get. Obviously, these guys will have been hit particularly hard, okay? They're one of the largest oil companies in the world and produce nearly 3 million oil equivalent barrels each day. We all know what's going on right now. Their upstream operations, which is 77% of 28 earnings, explores, produces and transports crude oil, natural gas and LNG. And then 22% of their earnings in 2018 came from refineries that use crude oil to make petroleum products such as gasoline, jet fuel, the list goes on and on. Here is a company who that we can see is quite clearly extremely cyclical in nature, okay? We see these massive ups and these massive downs, these massive ups, and now we're into an absolutely massive down that we have not seen in a very long time. We can see that they temporarily dropped as low as down 50%, and now they're only down 20%. So it's been a very nice recovery for these guys thus far, despite everything that is happening. And I think everybody knows that there is now some optimism in the market in regards to oil-related stocks. Things are starting to come back to normal. We have an idea of when oil production, supply and demand could be back to normal, which is giving people, enthusiasm in the market. And Chevron have a lovely balance sheet that would, give more evidence that they will continue to pay their dividend. Current assets 28.5 billion, total assets 236.6 billion, current liabilities 28.2 billion, and total liabilities of 91 billion. So a very nice balance sheet. So they've come out and said that results will remain depressed as long as oil prices stay low. And that is quite obvious. You don't need to be a genius to figure that out. And they've also said that it is making additional cuts to its capital spending plan, which makes that balance sheet look even more appealing. If they're going to be able to, spend less money, happy days for us investors. I think what's really important to remember is that as soon as this virus situation is over and done with, as soon as economies open back up, as soon as countries open back up, oil demand is going to go straight back to where it was before. People are going to be flying again, there'll be cruises going again, you'll be driving to and from work, you'll be driving around with the family, going wherever you want, you'll be doing things that you aren't doing right now that involve oil. So it's going to be tough, and who knows when the stock will start to go back up. It could be 3 to 6 months, it could be 9 to 12 months, who is to say? I do believe though that by the end of this year, oil will be somewhat back to normal, and we will see these companies start to grow again. But I'm going to leave them there. I don't need to speak too much more about them. It's a lot of the same points as Exxon. Very cyclical nature. Blah, blah, blah. You get the picture. And that is the 5 stocks that we're going to be speaking about today, guys. There we are, guys. 5 high-paying dividend stocks. 5 to 9% dividends. That's a high dividend, guys. And these companies are the companies who are more than likely going to keep paying these dividends regardless. They have enough money to do so, and they've paid them for so long that they don't want to cut them no matter what happens. It's going to be their main priority going forwards. Also, a lot of these companies have had shaky recent years, which some people may well see as a bad thing, and I do get that, but it could give us an opportunity to get into them cheaper than we could have. Definitely not the safest companies in the whole wide world, but generally, the safest companies in the world aren't going to give you a 5 to 9% yearly dividend yield. I do hope that you enjoyed though, guys. If you did, please smash the video a like if you haven't yet. It does mean an awful lot to me. Subscribe if you're new around here, join the family, and I will see you all for tomorrow's video. Have a great day, guys. Peace.